we look at that example in the yesterday also, how the depreciation policy will make your profit and loss look better. So in this case, this is the real life. Machine is 600,000, useful life is 5 years, and residual value is 100,000. So how much will be the depreciation? 600 minus 100, 500,000, divide by 5. So $100,000 each year, right? But the company changed the policy. Company decide, no, we will not depreciate over 5 years, we will depreciate over 10 years. And the residual value is actually very high, 200,000. So how much will be the depreciation now? 600 minus 200, 400,000, divide by 10 years. That is 40,000. So instead of 100,000 depreciation, company is charging 40,000. So how it will affect? This is the company's profit and loss statement. Here you can see company is just making enough. So company's taxable income is 60,000. Because company is charging only 40,000 depreciation, right? But if company charge 100,000, then what will be the taxable income? If company charge 100,000, the taxable income will become 550. Zero. Almost zero, right? Correct? So what will be the impact then? Their profitability will become zero. So in order to show a higher profitability, they just reduce the depreciation. So if you want to show we are profitable company, don't charge depreciation or charge less depreciation, right? But what will happen? Your assets will not be depreciated. You don't have enough money and you have to pay a higher tax. In this case, the company is paying $15,000 in taxes. And if they follow the correct accounting policy, how much they have to pay? Zero. So the company is paying cash $15,000 just because of change in depreciation policy. Okay. There are other possible manipulations. Normally, unusual decrease in receivable, inventory, or increase in payables to show better operating cash flow, or operating items classified as non-operating to show better operating margins. We know that we normally compare companies' profitability by looking at operating margins, not at non-operating margins, right? Non-operating expense normally analysts ignore because they are not related to the business operations. So you can classify your actual operating item. Maybe let's say, as you said, CEO is not operating, right? So CEO salary go to non-operating expense. So your operating margin will improve significantly, which is not actually true, right? Correct? Or hiding obsolete inventory. Yesterday we see that inventory's value is going down and down and down, but we are not charging that to the expense. We are keeping our inventory as it is. We are not looking at the reality that this inventory is still worth in the market with the same value or not. Correct? So you can manipulate like this.
So what's the, is there any legal charges for manipulating this?
Yes, jail.
Oh. Like for putting CEO salary in net operating?
Oh, yes. The shareholders can sue.
Okay.
If they sue.
Shall we have a break?
Now we are finishing. We are finishing. Yeah. We are finishing soon.
We have super brains to absorb all the information.
Yes. No, it's almost finishing. Almost finishing. So otherwise we have to spend, or you want to do a break? But it's almost finishing now. Another 10-15 minutes it will finish. Huh? Yeah. Okay. So normally we analyze the profit and loss statement and balance sheet together. So sales is linked with the client receivables, right? Now either cash or client receivables. So if you are booking sales, fake sales, the client receivable will go higher also. Correct? Cost of goods sold is linked with the inventories. If you try to reduce cost of goods sold, your inventory will go higher. And cost of goods sold is also linked to the inventory suppliers. right? Sales also linked to the payables. If you decide fake sales expenses, then your payables will also increase unusually. So you have to look at the ratios. So current ratio, your payable turnover ratio. For example, in the Samsung we say they are paying 150 days, but actually may not be true. They may be paying only in 30 days. The rest of the liabilities are just outstanding. They are recording the expense without actually paying them, right? So it may not be always true what you see from the ratio. You have to go behind the scenes. Okay, interest due, depreciation is related to the long term assets. So if you don't charge depreciation, your long term asset will not reduce, so your return on assets will be deteriorated, correct? If you want to increase your return on assets, you depreciate your assets faster. Taxes due are linked to the tax payable, and net income is related to the retained earnings. If whatever net income you are having is not passed on to the retained earnings, there is a problem, right? You can offset between the two. You can make adjustments.